Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, February 1st, and then we'll see how things look for Thursday, February 2nd. There was positive reaction to the Fed announcement that they raised interest rates 0.25%. There was some initial gyration that took place, and then once things got settled and the press conference was underway, prices ended up moving higher. So we added more to the gains. We broke through some resistance. We're getting a little bit more short-term overbought, but you can also see this as positive momentum as we go higher and higher, and folks are finally starting to realize maybe the market can go up after all. So let's go back and talk about what happened. Right at the open, we had a lower open. Prices fell down below the daily pivot at 40.58 before settling into sideways action prior to the Fed announcement, and that's pretty common. As the day went on, we had the typical post-announcement gyration with prices moving higher. They ended up going up through R1 at 40.96, all the way up through R2 at 41.15, and they almost made it to 41.50. That was not a pivot level. That was just a psychological number that the market was a little bit focused on. And then we ended up retreating down to R2. Going into the close, we closed a little bit back above R2. We were up 1.5%. Volume was slightly above average. The technicals are more or less positive. The market, of course, is really fixated on this inflation and interest rate scenario, which is bleeding through into the earnings per share and valuation concerns. We're keeping an eye on the geopolitical concerns between Russia and Ukraine. Earnings are coming out, and that had a bit of a drag on the Dow that I'll just briefly cover here in just a moment. We had lots of Fed speak because of the press conference, and the market seemed to like what they heard, even though they could have gone down just as much as it went up. And the debt ceiling issue that is going back and forth politically and not really getting resolved. And then I'm hearing some news coming out of India. One of the richest persons in the world is really suffering a lot with the number of companies that trade in India. I don't know if that will feed over into the U.S. markets or not. That's why I have it in white. But it's just something to be aware of to see if it does have any impact on the U.S. markets. Here is the intraday chart where we had a lower open. We came down to the daily pivot, went up above the daily pivot, down below the daily pivot, and we just kind of settled there until the announcement was made. Here's the initial gyration followed by some more action. Then we ended up going down. We didn't quite make it down to S1. I didn't really include that because the market really turned around and started to go back up. We were able to get back up to the unchanged level. We made it through R1, through R2. We never did hit R3. That was still quite a ways above where prices went. We topped out at about the 41.50 level, just a little bit below that before coming back down and then closing just above R2. Here is a 1-minute chart just showing how the market reacts, where things were pretty quiet going into the meeting. Then you had the initial gyration where prices initially went lower at first, then they came back up, then they went back down. We ended up setting the low right at about the time the press conference began, and then we just shot up after that. There were some little blips and pauses along the way before hitting the high and then coming back down into the close. What are some comments that we can make? As expected, the FOMC decided to raise the Fed funds rate by 25 basis points. So now we're at 4.5 to 4.75. Some of the text of what Chairperson Powell said was that the full effects of rapid tightening so far have yet to be felt, and we have more work to do. So it's kind of a two-pronged warning based on what I hear, is that we've been raising interest rates and it hasn't worked their way into the economy, so that could slow down the economy. And on the other hand, he also said we have more work to do, which means we're probably going to continue to raise interest rates. The market could have just tanked on this news, but it chose not to. He indicated that the core services inflation is still running too high, which creates a basis for the ongoing rate hikes. And he's also looking at employment. However, Mr. Powell was generally encouraging about the emerging signs of disinflation. So he's seeing all these reports that are coming out and how things have been coming down and inflation is lessening, but it's not at the place where the Fed is really happy yet. He didn't speak against the recent rally that we've seen since the beginning of the year, and he thinks that there's a path to getting inflation back down to 2% without really ruining the economy in the process or hurting employment at the same time. On the heels of this news, semiconductors continued to do well while energy declined in the session. They were the only sector that was down, was the energy sector. The Fed, the ECB, and the Bank of England will be making rate decisions this week. We have the decision from the Fed. Now we're going to see what comes out of Europe. There are over 100 companies that are reporting this week with their earnings. The Dow is virtually unchanged, with Amgen, Travelers, and Chevron either having negative earnings or guidance or just being dragged down by the energy sector. On a short-term basis, we have the moving average study, the shorter-term one that I'll show you, looking a little topsy, but again, this could be taken as more of a momentum move, and it's going to go into overbought territory. And that's why I keep saying that even though we're overbought, it doesn't mean we have to stop. We just might slow down a little bit. Our stochastics, the Stochh RSI, and the Williams percent are looking even more extreme positive. On an intermediate term basis, we have the CCI 14 as well as the 20. And long term, we still have that moving average study. And I'll have charts of all these to show you. The dollar was down as well as interest rates. And copper, it declined in Wednesday's session, but it's still holding on to the majority of its gains. The 10 to the 5, the 10 to the 2, and the 10 to the 3 month are still inverted. Sentiment is positive, giving us a reading of 73. Once we get over 75, that's when we start to get an extreme positive territory. I'll look at the economic reports on the next slide, and our trend is positive and getting stronger. The ADX is going up, but we're still below 20, as I keep saying over and over. The bias is positive, and our momentum continues to be positive. The economic reports that came out, we had the MBA Mortgage Applications Index. It was down 9%. The last time we had this reading, it was up 7%. The ADP employment change, it came in weaker than expected at 106,000. They had expected this report to come out at 170,000, and the last time it was at 253,000. Are we starting to see some weakness in the employment situation? Now, we'll get the big reading on Friday, but this does not bode well for employment going forward currently. The IHS Market Manufacturing PMI, their final reading came in at 46.9, a little bit better than the 46.8 we saw last time. Construction spending was down 0.4%. They expected it to be unchanged. Last time it was up 0.5%. The big one was the ISM Manufacturing Index. Came in at 47.4%. They expected it to be at 48. When it's below 50, that shows contraction. Then the last time we had this report, it was at 48.4. So we're still under that 50 mark. The JOLTS job openings came in at 11.012 million. The last time it came in at 10.44 million. So the job openings have actually increased. Here are some charts that are put out by a person named Tom McClellan. His parents were the ones that invented the McClellan oscillator. From that, we also get the summation index. And he lives in Tacoma, Washington, which is the area I am from. They may give us some insight or at least clarify where things are at right now. So I wanted to include those in the video. This is the presidential cycle pattern. And just about where we're at right now, if you match it up with what has happened historically, we should have a pretty good run up going from here. Now, it doesn't mean that we're automatically going to go up, but historically, the markets do go up ahead of the presidential election, which will be coming in 2024. Here's just more of a historical chart showing here's the Fed funds target and how it's been going up, as well as the 2-year T-note yield, and then how the Fed has been doing things at other times when they went too far, when they went oops here, when they switched from one side to the other, just to give you some historical perspective. And when they talk about Greenspan, he was a former Fed chairperson. Here's another chart showing the total treasuries and the MBS, which are mortgage-backed securities that are held by the Fed. They are starting to decrease their overall balance sheet as the market has been coming down. And you can see when the Fed did things before, either QE or QT, what that did to the market overall. And so this produces quite a headwind currently with the markets. The next chart shows the monthly S&P 500 and the federal tax receipts, the 12-month trailing total divided by GDP. Somebody sat down and actually figured this out and said, okay, maybe this will give us some insight. We're pretty high now. But it says here that since 1946, the average of the total federal receipts is 16.5% of GDP. We're well above that. This just suggests that the government is receiving a lot more in taxes. And this could be coming down. When taxes are going up, the market tends to go up, as it did throughout 2010 through about 2016. Well, it's really been going up now, so this might be able to give some support to the market. Another chart, the unemployment rate, which is in red, the CPI, the 12-month rate of change, and they shift it forward 2 years, this tends to follow the unemployment rate. As CPI is going up or down, employment goes up or down if you shift it forward. The next chart just shows consumer sentiment, where it's inverted and shifted forward by 10 months. When this gets really high, that means there's a lot of pessimism. And then you have down here the unemployment rate, which is still really low. So we're seeing a real wide spread between what usually happens, because these tend to move in the same general direction. They're going in opposite directions right now. So which one's going to give? Here's the CPI 12-month rate of change looking at the 5.31 year cycle. I don't do a lot of cycle studies because sometimes they tend to help and other times they're like, okay, I'm not seeing the relationship. But what he's suggesting here is that the cycle's been going up and now it's starting to come down as the rate of change of the CPI is also coming down. Here's the S&P 500, also looking at the CPI with the rate of change, where the CPI has been coming down, and will that either give some support to stocks or cause some more headwinds? Another chart that's not McClellan, this is another chart that we've been looking at copper, where we had the ISM manufacturing come out, and that is the white line here, where it had been going down and now is starting to bounce back up. In blue, we have the price of copper, where it's been going up and is now turned down slightly. But these two have a tendency to move in the same direction, where lately they've been going in opposite directions. Maybe they're trying to work their way back to being more balanced. Looking at the equity put call ratio with the advance we saw on Wednesday, this continues to decline, so we're still working off of this spike. This often gives support to the S&P 500. The Ulcer Index also is suggesting that fear is really low. Looking at the VIX, we continue to drop, which is also suggesting that fear is very low. We're really going down based on a closing basis, and the bar chart is really decreasing. And we look like we might be breaking out with some volatility. This is the VIX of the VIX, the volatility of the VIX. Well, that seems to be turning around now, where volatility is really decreasing, both on the bar chart and on the line chart. Our trend is still trying to get back up there. It's above the moving average and advancing, but we're still below 20. The green line is on top. So it is positive, but we're not really in a trending environment, at least yet. I know it may not seem like that, but with all the chopping around we did in November and December, where the ADX was so very low, trying to get us back into a trending type of an environment takes a lot of effort by the market. There's our daily chart. We were able to get back up through this resistance level, which had been providing some problems for the market. We also were able to get back through the December highs and close above those. Down at the bottom, we see where volume really increased. Here's our moving average study. We're not really extreme yet, but we're getting close with the 20 period, the 50 period, and we're going higher with the 200-day exponential moving average. Stochastics, extreme positive in the short term. Coming down a little bit, but still extreme in the intermediate short term, and the long short term is still extreme positive. The slope, not really turning back up. It's looking a little better, but not turning up the way you might expect it when we saw a fairly sizable up move over the last 2 days. Stoch RSI starting to get extreme positive, but it can stay there for a while. And the same thing can be said with the Williams percent R. Even though it ticked down, it's still in extreme positive territory. Here's the PMO study, not showing necessarily that these two top areas are extreme with the PMOs that are rising. They're looking positive. The buy signals are turning up, getting a little bit extreme positive with the PMOs that are above zero. Here's the PPI, coming up to the underside of 70. This continues to show that things are positive and not extreme yet. Now, the BPI crosses above this green line, and that would be more into extreme positive territory. Here's the bullish percent index for the NYSE, where we are starting to break out, and that is giving some support to the market. Chaikin money flow, looking pretty good right now. CCI 14 and the CCI 20 continue to be extreme positive. We broke above this anchored moving average going back to the all-time high in January of 2022. That could be seen as positive. The TTM squeeze has gone back to the more shaded style of blue, so that is more positive. The rate of change going back 20 periods, just barely getting into extreme positive territory. Volume did pick up, so that's why we're seeing the black line and the red line continue to go higher. The vortex, this was interesting. I just wanted to show this because it was strange, where We were up on the day, but yet the buyers decreased and the sellers also decreased. I'm not sure really why the buyers decreased on this particular indicator. With our short-term fib levels, we're coming right up to that 41.23 level. We're just a little bit below it now. We closed at 41.19, so we're about 4 points away. Can we break above this, or is this going to act as overhead resistance? Longer term chart, we have some more overhead resistance at the 42.14 level. That's still a ways away from where we're at, but we still want to keep that in mind. But the fact that we're more comfortably above this other fib retracement level at about 40.20 is positive. Swollen trading oscillator based on price and volume continue to turn back up and are looking more positive now. We're above all the moving averages in our moving average tree. Elder impulse for the S&P is still green. That's positive. The summation index based on price and volume continue to advance and are not necessarily getting extreme yet. The new highs, we finally saw a bit of a breakout with the new highs. So our 5 period is turning back up. We're flat to slightly higher with our 10 period. Advanced decline line, looking better as we're breaking above the moving average even further based on price. And then with volume, we're still showing some improvement. If we can stay above this red line, that may turn the moving average up. Copic curve with the upward movement, it was just about getting ready to cross, but that may be delayed a day or two. Our longer term moving average study, getting extreme with the 150 and the 200-day simple moving averages. The NASDAQ is still well above its 200-day moving average and had a good day. It was up over 2%. The NASDAQ 100 also had a good day, up 2.16%. The Qs also continue to advance and have turned back to positive. The home builders also had a good day. We're breaking out here with the S&P 500. The home builders ETF is also now starting to go up. The ratio is going higher, and we're getting back to the point now where the home builders and the S&P are going in the same direction with a pretty strong relationship. Semiconductors, after giving a recent golden cross, had a really good day. We're up 5.21%. That's a huge part of the tech sector. The small caps are starting to show some strength here after being in a sideways to slightly positive uptrend. Here's the small cap index up 1.49%. The small cap, the S&P 500 ratio, starting to see this red go up, and that is giving some support to the blue, which is the S&P 500. Here's the small caps up 1.61% and looking much better. Here's the high beta stocks, the ones that outperform the market either to the upside or to the downside. When we're going up with this and we see the blue lines, that's a risk on posture. That means folks are dumping into stocks. When we're going down and we see these red lines, that's a risk off posture, and folks are getting out of stocks and getting into other investments that are considered to be safer. Well, for most of 2022, we've been in a risk off type of scenario. Since the beginning of 2023, we've been going up, and we're starting to see some real improvement with this ratio. Here's also another look at fear. Lately, we've been seeing fear really decrease. That's why there's a blue line here, and that is giving some support to stocks. We compare the 3 to 7 year bonds with the investment grade bonds. Looking at our possible positive scenarios, I tried to draw a little bit more on here of some positive and negative divergences. We've seen the ratio between the Qs and the S&P start to go up and showing some real improvement. The discretionary to S&P, which has been doing a lot better, that's improving. And then the large cap growth to large cap value has also been showing some recent strength. Here's the other chart, which just looks at growth and value for the large caps, looking better. Mid caps showing some improvement. Small caps, not a lot of improvement. Because the other ones are improving, you could say this one is improving as well. Here's our 50-period exponential moving average of the new highs minus the lows. And what I do is I plot the highs and lows on this chart, and then I turn it invisible, and then I have a moving average plotted on here, and that's the only thing that you see. We spent most of 2022 below this zero line, which was more negative, and we continue to show some strength. That could give some good support to stocks. This is that same chart with the actual indicator plotted here, and then the red line is the moving average. When we're above zero, that's positive. When we're below zero, that's negative. We want to stay above zero for as long as possible to turn things back more positive. Looking at the 2-year Treasury yield against the S&P 500, the yield spiked up and it seems to be coming back down. We're not really sure though. We've been faked out by this before, so we just kind of have to wait and see what will happen. And when the 2-year yield spikes and comes down, oftentimes that gives short to intermediate term support to the S&P 500. Here's the NYSE breadth thrust giving us a signal that it was generated back in October. We're still coming up, and this is showing some improvement over here by Shavaco Capital, saying that when we work off of these signals, 1, 2, 3 years out, we have a 100% success rate. Doesn't mean we're going to go straight up. There could be some massive bumps along the way. In the long-term scheme of things, they are positive. Here's our staples, the S&P 500 ratio, where it's been coming down. It was back up a little bit on Tuesday. It declined just a little bit on Wednesday. We're still working off of this spike, and then this decline, that often marks a low in the S&P 500. So our outlook then for Thursday, we have still a couple of major economic releases. We have the ISM non-manufacturing, which will be coming out on Friday. The employment situation report also on Friday. The technicals are positive. We're still above that long-term resistance, which is the trend line. At some point, I'm probably going to switch that over if we can stay above that level. I'm just kind of waiting to see and let a little time pass with that. But we are becoming short and intermediate term overbought. On Thursday, we have jobless claims coming out. The preliminary fourth quarter productivity, as well as the unit labor costs, will be released. Factory orders will be released as well. Then the geopolitical events, Russia-Ukraine, just keeping an eye on that. Inflation and interest rates, that's what the market is really fixated on. Earnings as they're released, and that can have a real impact, such as how it played out on Wednesday with the Dow. Any more Fed speak that we might get, and the market's still trying to digest the Fed speak that they just received. And let's see, the debt ceiling, which doesn't seem to be getting all that resolved currently, and then potentially India, if that is like a contagion type of a thing that works its way into the U.S. stock market. Looking at the Stock Traders Almanac statistics, I went through these a little bit more in yesterday's video, but the S&P was up about 60% of the time in February, down 40% of the time, and the return was not very good. When we're in a pre-election year, which that's what 2023 is, we're up 66 2/3, where we're down 33 1/3. The day before President's Weekend, we still have some time off for that. We're down 58% of the time. And then from 1992 to 2002, we were down 11 times in a row. But in the last 13 years, we've been up 8 of those times. During the week of options expiration, we're up about 72% of the time. For February 2nd, not really some good statistics here. The Dow is basically more negative. It's only been up 47.6% of the time. The S&P is a little bit better at 57.1, where the Nasdaq's at 52.4. Then for the month of February, going back over the last 73 years, we've been up 55% of the time and down 45% of the time. We do have the January barometer now, so that gives us a score of 3.0, which indicates that we could be looking positive when you project out for the full year of 2023. And the markets still like that we're split between Republican and Democrat in the government. So our scenarios, can't really go with the down one. Things are going up pretty fiercely right now. The technicals are positive. We're above that trend line, but on a slightly negative stance, we could be getting overbought in the short and intermediate term. Can't really go with the up one either. Even though we've been going up, we're still in a trendless environment right now. So that's what we're going with. The ADX is getting stronger though, but it's still below 20. The green line's on top, so it's positive. Our conclusion, the S&P is positive, still above that trend line, but we're becoming short and intermediate term overbought. In the short term, overbought but positive. Intermediate term, positive but becoming more overbought. Long term, we're positive as we get above the 200-day simple moving average. I didn't show that on any of the charts, but we're also getting ready to what could be a golden cross with the S&P, where the 50 period moves above the 200-day moving average. Thank you. Have a wonderful day on Thursday, and I will talk to you in the next video.